So our life cycle basically looks like this. Life cycle looks like this. So we have what we call research and development. Research and development. So any product, ladies and gentlemen, of course, before you get into production, it would be very important for us to get engaged in research and what here? Research and development. Very important we get engaged in research and development. We just don't wake up one morning and we say we are developing a product. We are starting selling a product. No, there must be that phase where we look at the viability of this product. Is it viable? Where we develop a prototype, etc. So research and development. From there now we have birth or introduction to the system, to the market. After birth, of course, if it's a good product that has got a potential, it must grow. It must grow. So we have the growth stage. So of course, always you can grow forever. After some time, even binadamu lazima utafika mahali kama saa mimi umeshafika namna gani, somebody umeshafika your maximum. Ushafika your maximum. So this maximum is what we call maturity. Huwezi endelea kugrow forever. Utakuwa giant. Utakuwa giant. After that, kamgongo kanaanza kubenda. So we have what we call the decline stage. Decline stage, like now most of our parents are the decline stage. And then of course, whether you like it or not, it's bad, but whether you like it or not, we must have what we call death and being removed from this world, what we call withdrawal. Quite a bad stage. So like that, every product, ladies and gentlemen, must go through this cycle, So when you talk of life cycle costing, for us, life cycle costing, ladies and gentlemen, basically here we ascertain the total revenues over the entire life cycle or lifetime of what year of a project. That is number one. That is what we do, number one. And then number two, still under life cycle costing, we must come and ascertain the total cost. We must come and ascertain the total cost over what year somebody over LCT of the project or product. Sorry, product is better. Product. So in this case here, we must come and get the total cost over the entire life cycle, what year, time, life cycle time of the product. Of course, at the end of it all, what are we interested in? We are interested in the profit. We are interested in the profit over the life cycle of the product here, of the product. So ultimately, what we want to do under the life cycle costing is to get profit, which is the total revenue over the entire life cycle minus the total cost over the entire what year, total cost over the entire life cycle, Remember, the traditional method, ladies and gentlemen, traditional method, fine, we still get profit, yes, but in defined periods, most especially in defined periods, mostly yearly. So let's say, for example, this is the income statement of EABL over the period ended 2021. That is a traditional method. But for a life cycle, ladies and gentlemen, we will transcend over 1 year. We'll ask ourselves if it is Tasker. This Tasker will take how long, or rather will contribute how much over its entire life cycle. So this life cycle costing is so important because at times we'll get ourselves, in this case here, celebrating over performance that is not sustainable. We'll get, for example, somebody saying, hey, Equity Bank made profits of 18 billion last year, and everybody is very happy. People are getting dividend, forgetting that this product perhaps is still here. And later on, when it will come to the decline stage, most of these profits that you're making here earlier, these earlier stages, you may want that profit here to do what? Here to start, for example, more marketing, right? At this decline stage. At withdrawal, of course, you must make good the grounds. So in this case, ladies and gentlemen, this traditional method will always give us what we call deceptive profits. The profit here will be deceptive. When you look at the entire life cycle, you're able to get a clear picture because you'll be able to look at all the seasons, and of course, you're incorporating what here, all especially costs. Now, ladies and gentlemen, when we talk of the question that we have now at hand, this is the question that we have at hand. A company manufactures MP3 players. It is planning to introduce a new model, and development will begin very soon. It expects the new product here to have a life cycle of 3 years. 3 years, I have to underline this, 3 years. And the following costs have been estimated. So we have year 0. We can see year 0, we have the research and development. We have year 1, you can see the units produced like that. And then at the end of the day, they want us to calculate the cost per unit. So first of all, we must get what we call the total cost. So can I rub my board? Remember, this was just a quick reminder. Can I rub my board very fast? Great. So remember that this is life cycle over how many years? 3 years. So I need the total cost over 3 years. So we have year 1, we have year 2, year 3. Year 1, 2, 3. So we're looking for the life cycle cost over the entire life cycle. So the first cost that I've seen there is called research and what year? Development. Sorry, I forgot year 0. Research and what year? Research and development. So under research and development, ladies and gentlemen, here, we are told research and development. I can see 800 and what year? 850. 850. 800 and what year? And 50,000. So year 0, we have 850,000. 850,000. Great. Now, do we have, remember, you're looking at the entire what year? You're looking at the entire expenses. That is the first expense. The second expense there I can see is the production cost. And then we have the variable production cost. So I'll come and mention here, variable production cost. Variable production cost. Now, this variable production cost, you can see these guys are crazy. Why are they crazy? I'm saying they're crazy because they have given me variable cost per unit. So whenever you're given expenses on a per unit basis, what should we do? Remember, under life cycle costing, we want the entire thing, the entire cost. We want the total. So whenever you are given expenses for 1 unit, always the number of units here produced must be involved. So they take the variable cost per unit given there times number of units for each of the years. Like now, ladies and gentlemen, I can see variable cost per unit. Year 1, it is 30. So I'll say 30 times what here, somebody? I'll say 30. I hope you're able to see the number of units manufactured up there. 30 times 25,000. Because remember, life cycle costing is about total. Is there somebody who is able to give me these figures very fast? For year 1, I'll take 30 times 25,000. Year 2, I'll take 25 times 100,000. Year 3, I'll take 25 times what year? 75,000, like that. So please give me figures here. Please give me figures. I know already you have taken a screenshot of this question. So year number one, what do we have? Somebody for year number one here, somebody. Do we have those figures year number one? So Susan tells me 75,000, 750, yeah? 750,000, thank you very much. 750,000 year one. And then year two, somebody has already given me a figure of 250. Is it 250 or 2.5 million? 2.5 million. 2.5 million. And then year number three, 750,000. I hope these figures are okay. 750,000. So please, I would want you to create a column here for totals, eh? Totals. So research and development is 850,000. How about the total variable production cost? You add the three. The total production cost, you add the three. Total production cost, you add the three. Total production cost, you add the three. I don't know what year three is 1875. 1875. Or is that total really? 1875. Year three, 1875,000. 1875,000. So how about the total here? Somebody, how about the total? How about the total? So according to Technol, it's 51,25,000. 51,25,000. So from there, we go to the next cost. The next expenditure given, ladies and gentlemen, here, this is a straightforward thing. The next expenditure given here, is called fixed production cost. So for fixed production cost, of course, we'll just copy the figures the way they are. Fixed production cost will copy the figures the way they are. Why? Because they've given us lump sums. So fixed production cost, nothing there, nothing there. Here we have 500,000. Here we have 500,000. Here we have 500,000. So could you kindly give me the total here? The total will be 1.5 what year? The total there will be 1.5 million, like that. That is fixed what year? Fixed production. That is fixed production. That is fixed what year? Fixed production. That is fixed production. So fixed production, hakuna kumultiply the number of units because hawajatuambia per unit. Hawajatuambia per unit. So after that, ladies and gentlemen, we go to the next one. The next one which they have given us here is the variable marketing. So akisema variable marketing, unacheza kama wewe. Variable marketing, unacheza kama wewe. Sababu wamekuambia variable marketing per unit. So wanatupatia the total variable marketing cost. The total variable marketing cost. So the total variable marketing cost they have given us there for each unit. So please multiply by the number of what year units to get what year to get total. Multiply by the number of units to get total. So in this particular case, ladies and gentlemen, for variable marketing, I can see the first one there is 5. So it will be 5 for year 1, 5 times number of units are 25,000. Year 2, I'll take 4 times 100,000. Year 3, I'll take 3 times 75,000. Could you kindly give us figures? Could you kindly give us figures? Could you kindly give us figures there? 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 So we have the first one is 125,000. The second one will be 400,000, 400,000, 400,000, 400,000. The third one, 225,000, 225,000, 225,000. So please add the 3. Add the 3, give me the total. Add the 3, give me the total. So the 3 will be 750,000. Thank you very much. 750,000, 750,000. And then we have the next one will be the fixed marketing. The next one will be the fixed marketing. The next one now here will be, we are told the fixed marketing cost. So the fixed marketing cost, what do we have here? The fixed marketing cost. So the fixed marketing There is nothing like multiplying. There is nothing like multiplying. So fixed marketing, what do we have here under fixed marketing? Under fixed marketing, ladies and gentlemen, fixed marketing. Under fixed marketing, there is nothing like multiplying. Fixed marketing, you simply take them the way they are. We have 300, 200, 200. 300, 200, 200. So we have here 300, 300, 200, 200,000. I hope we are together. I hope we are together, ladies and gentlemen. I'm trying to move a bit fast because there are those students who say they are okay. But I hope even the ones who are seeing this for the very first time, they've already gotten some concept, right? They've already gotten some concept, right? 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 700K. I hope we are together, all of us. I hope we are together, all of us. I hope we are together, all of us. Are we okay? Are we okay? Are we together? Are we together? Yes, sir. Thank you very much. Great. Okay. Now we got the next one. The next one is the distribution cost. The next one is the distribution what here? Cost. Next one is the distribution cost. So under distribution cost, we have the variable cost per unit. So variable distribution. So we have here variable distribution, which is for 1 unit. So I have to involve number of what here? Number of units. So number of units will be taking like under variable distribution, like you take 1 times 25,000. That will be 25,000. 25,000. And then the next one we have in this case here, the next one will be 2 times, not 2, but 1. 1 times 100,000. That gives me 100,000. The last one will be 1 times year 3. So 1 times 75,000, like that, 75,000. So please give me a figure there for variable distribution. From there, we have the fixed distribution. So we have here fixed who? We have fixed distribution. So for fixed distribution, mine is simply to copy the figures. So for fixed distribution, I have 190, 190, 190. So we have here 190,000, 190,000. Here we have 190,000, 190,000, 190,000. Please give me the totals. Give me the total variable distribution cost first. Give me the total variable distribution cost first. 200, eh? Thank you very much. 200,000, 200,000, 200,000. From there, we have the fixed distribution 190 times 3, 570,000. And then now we have the last one, 570,000. And then we have the last one. So the last one is the fixed customer service cost. Variable, so fixed, now that one I've already taken care of. So now we have the customer service cost per unit. So we have service cost is per unit. So now we have the service cost. Service cost. So service cost, what do we have there? Dash. So it's for 1 unit times number of units, like 3 times 25,000. That gives me 75,000. Go to the second one. 2 times 100,000. That gives me 200,000. The next one, the last one is 2 times 75,000, which gives me 150,000. So could you kindly give me these figures now? Kindly give me these figures now. So service cost, what do we have here for service cost? Service cost, what do we have here for service cost? Service cost, how much do we have? 425,000. Thank you very much. Now come and do me a favor very fast. Now that we have all the expenses, please give me the total expenses. Okay, ideally, you're supposed to be getting the total expenses for each of these periods, right? But in this case here, specifically, they only wanted the life cycle cost. So the life cycle cost. So please go ahead and give us the total life cycle cost. Add up everything. 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 Give us the total life cycle cost. Okay, so I'm waiting for the answer. I'm waiting for the answer. Okay. So what is that? Here has research and development. Research and development already have the 850. Which one has got research and development? There is a student saying that there is a year which has research and development. Year one has research and development. Okay, okay. So year one, I'm being told that year one has research and development. Okay, let me have a look at it. So year one has research and development. Being told mwalimu year one has research and development. So year one has research and development. Okay. So year one, research and development. Yes, there are two, 850 and 90. 850 and 90. There are two of them, 850 and 90, sorry, 850 and 90,000 for year one. Then these will be what year somebody? What will be the research and development for year one? Research and development for year one. Total research and development for year one. Takuwa ngapi somebody total research and development for year one? Wanasema ni 940. 940, sorry for that. So once I have my 940,000 there, then the total year will be equal to what? The total year will be equal to what? 10 to 10,000. 10 to 10,000. This is the total life cycle cost vis-a-vis the life cycle output. The life cycle output. So the life cycle output, please, over the entire life cycle, then we shall end up getting what here somebody over the entire life cycle. Please add up the outputs. Add up the outputs. We have 25, 175. Over the entire life cycle, what is the total output? Add the 3. 25. That I think should be 200,000. Over the entire life cycle, we shall produce 200,000 units. And therefore, the life cycle per unit, will be 10 to 10,000 divided by 200,000. Divided by 200,000, which will be equal to what somebody here, which will be equal to what somebody there. 10 to 10,000 divided by 200,000, which will end up giving us what figure somebody very fast. 10 to 10,000 divided by 200,000, which will end up giving us what figure? $51.05. So if you look at shillings or rather dollars per unit, if you look at, they told you to comment on the price, how have they been pricing this thing? Over time, the price they have been charging, I can see the selling price per unit. There's a place upper. Selling price, year one will charge 90, that is okay because it is over 51.05. Year two, they charged 80. Year three, the last year they charged 70. So you can see that the pricing is optimal. The pricing here is optimal. The pricing is okay because all the prices that they've charged, the yearly prices they've been charging are over and above what year the cost per unit, are over and above the cost per unit. So that is it. Iyo sasa kuisha maneno. Kuisha maneno. Any question? Any question? Is there anybody who has a question there? Anybody who has a question there? Now, I would want us to go straight away to this key limiting factor question again. Key limiting factor question. Key limiting factor question. Question number 2. I don't want us to do throughput. I know there is a time they asked about throughput, but throughput is beyond our syllabus. That time when they asked about the throughput concept, we never marked it at all. I only want us to do number 1. Number 1. Number 1. Number 1. Calculate the mix in units of product A and B, which will maximize the net profit and the value in dollar of the maximum profit. Look at the question itself. F company makes and sells 2 products, A and B, each of which passes through the same automated production operations. The following estimated information is available for period 1. So you can see the direct material A240 there. You can see variable production overhead, you're given 28.4. You can see the overall hours per unit, you're given 0.25, 0.15. Original estimates of production stroke sales of product A and B are given there, respectively. The selling prices have also been given there. Number 2, maximum demand for each product is 20% above the estimated sales levels. Estimated sales levels. So above the estimated sales levels here, we have 20% above. The total fixed production overhead cost is 1470,000. This is absorbed by product A and B at an average rate per hour based on the estimated production levels. Right? No problem with fixed cost. I know I'll be able to place it in my profitability analysis. Then we have a total, I don't know, one of the production operations has a maximum capacity of 3075 hours, which has been identified as a bottleneck or a limiting factor, limiting the overall estimated production stroke sales of product A and B. The bottleneck hours required per unit for product A and B are 0.02 and 0.0515 respectively. So they want me to maximize this in light of a key limiting factor. Can I give you 1 minute? Can I give you 1 minute to try doing this question? Just a minute, try doing this, try to figure out the question. Try to map out the question. Try to map out the question. A minute, try to map out the question. A minute, try to catch. Try to map out the question because I can see there is some scarcity there. So is there anybody who has been able to really try mapping out the question? Is there somebody who has been able to understand that question a little bit? Understand the question a little bit? Understand the question a little bit? Yes. So there are quite some low-hanging fruits here. There are quite some low-hanging fruits here because I've seen cost materials per unit, variable production overhead per unit. These are good costs here. Then what I'll be looking for myself here will be the selling prices so that I can get contribution margin. So low-hanging fruits there, low-hanging fruits there, low-hanging, very good. Hilda has already seen something there. Contribution margin for sure is a low-hanging fruit. Is a low-hanging fruit. Is a low-hanging fruit. Contribution margin per unit, contribution per unit is a low-hanging fruit. So remember the 4 basic steps. Number 1, if it's a limiting factor where we have some limitation, where we have some bottleneck, the first thing to do is to give us contribution margin. And if you remember, then contribution margin is price minus variable cost. We have A, we have B, we have the selling price. The selling price has been given there for A. The selling price for A that has been provided, the selling price that has been given for A that has been provided here, the selling price here is what? The selling price here is what? A is 60, B is 70. So 60, 70. So then we have the variable cost. So variable cost, what do we have there? Variable cost, we have direct materials. So we have direct materials, variable cost for direct materials. I can see we have 240, and then I can see we have variable overhead. I can see we have variable overhead of 28 and 4, of 28 and 4. So I'll come and subtract this for sure. I'll come and subtract this for sure to be able to get the contribution per unit. Is there somebody who has this contribution per unit here very fast? To be able to get the contribution per unit, so I'll go there and subtract very fast. Then what do we have somebody here? What do we have somebody here? For A, what do we have somebody here? Because you're subtracting only variable cost. 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 Please give me figures very fast. So 60 minus 2 minus 28. 60 minus 2 minus 28. Am I the one who is not seeing the charts or something? 30 and 26, okay. So the first one, I'm being given 30, and then we have 26. And then now don't forget to give us the scarce resource per unit. The scarce resource per unit. So the scarce resource per unit, if it's labor hours for each unit, here they have given us the constraining factor. They've given us the constraining factor. The constraining factor they have told us is here. Before required. One of the production operations has a maximum capacity of 3.075 hours, which has been identified as a bottleneck, limiting the overall estimated production stroke sales of product A and B. The bottleneck hours required per unit, the bottleneck, the scarce resource required per unit for A and B are 0.02 and 0.015. So we have here 0.02, 0.02, 0.02, and then we have 0.what here, 0.02, and then we have 0.015, 0.015. Great. So once I get this, the next thing will be for me to get CM per scarce resource. CM per scarce resource, can you go ahead and divide the two? Like now 30 divided by 0.02, give us a figure. 26 divided by 0.015. Please give us figures. So what is 30 divided by 0.02? 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 0.02. We're getting now the CM per scarce resource. So we're dividing. So Techno tells me 1,500. 1,500. So 1,500. How about the second one? Techno has raised their hand. The Techno, yes. If you can just very fast type there. It is 0.25, eh? A minute. So you see, here you should not confuse, because what this examiner has done here, he has given you the overall hours per product unit hours, overall, right? But you see the constraining factor has been defined down here. They've told you one of the production operations has a maximum capacity of 3.075 hours, which of course were given, right? Which has been identified as a bottleneck, limiting the overall estimated production stroke sales of product A and B. The bottleneck hours required per unit. Remember, it has to be scarce resource per unit for A and B, 0.02 and 0.015. Please, these are not for each unit, remember. These are overall. You should never be cheated by this examiner, right? So I don't know whether we are together up to there. I don't know whether we are together up to there. I don't know whether you're together up to there. I don't know whether you're together up to there. I don't know whether you're together up to there. Somebody, are we together up to there? Are we together up to there? Are we together up to there? They're not talking. Are we together up to there? Yes. Okay, great. So 1,500, and then we have 26 divided by 0.015, which will end up now giving us something nice there, which is 1733. Thank you very much. 1733.33, like that. So then, having gotten this CM per scarce resource, what do you think will be the next step? Having gotten this, what do you think will be the next step? Having gotten this, what do you think will be the next step? What do you think will be the next step? The next step, ladies and gentlemen, is to come and do what here we rank. Next step, come and rank. Next step, come and rank. So of course, the one that has got the highest profit, the highest contribution per scarce resource takes up number 1. So B will be number 1. This takes number 2. B has got 1733. So this takes number 2. Now from there, the last step, ladies and gentlemen, is for you to come and give us the optimal production schedule. So come and give us the optimal production schedule. So the optimal production schedule. So come and give us the optimal production schedule. So optimal production schedule, this will be B, product, this will be A. So we have here product A, and then we have demand. So demand, is there anybody who is able to see the product B demand that has been given? The demand for product B, is there anybody who is able to see the demand for product B? The demand for product B that has been given. Is there anybody who is able to see the demand for product B that has been given? The demand for product B, 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 the demand for product B. Is there anybody who is able to see 54,000 for product B? Is there anybody who is able to see 54,000 for product B? Jabir, where are you getting 120,000 from? Demand for product B. Demand for product B. Demand for product B. Demand for product B. What are you able to see as demand for product B? You see, they've told me here, the original estimates for A and B sales will be 120,000 and 45,000. But now this examiner is a right examiner. You went ahead and told us that the maximum demand, remember here we normally work with demand. The maximum demand for each product is 20% above the estimated figures. So then it will be 120% of 45,000. Remember, we're starting with B, right? We are starting with B. 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 So, right, Steve, yes. So it should be 1 to, yes, 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 yes. So B should be 54,000. B should be 54,000. Thank you very much. How about A? How about A? So A will be 120,000 times 120%. So A will be 144,000. Thank you very much. 144,000. Remember, as I'm contemplating to produce, what I'm very much worried of, ladies and gentlemen, is the scarce resource, the bottleneck hours, So remember, for these bottleneck hours, fortunately, we know each product, each unit should be taking how many hours. We know that for B, the scarce resource, for B, it is 0.015, and then for A is 0.02. Could you kindly give me the scarce resources hours to be utilized? Give me the scarce resources hours to be utilized. Give me the scarce resources hours to be utilized. Because remember, it's a limiting factor question. So I'm thinking about what is this scarce resource that is going to hinder my productivity? What is this scarce resource that is going to hinder my productivity? So then 54,000 times 0.015 will give me what figure? Will give me what figure? Will give me what figure? So this one, no. Nobody has given me a figure there. Nobody has given me a figure. 810, really? 54,000 times 0.015. So in this case here, somebody is giving me a figure of 800 and what here? 810. How about the second one? The second one, what do we have there? The second one, what do we have there? 2880. The second one, we have 2880. Now, I want you to pull it from there. So hours needed for maximum demand. Hours needed for maximum demand. Could you kindly add there? Hours needed. Yes, thanks, Jamie. Hours needed for maximum demand are how many? Hours needed for maximum demand are how many? 3690. Now from there, I would want you to take a minute and look at the hours which are available. Hours which are available. Please give me the deficit in a minute and do, in this case here, the counting backwards. And then we see how you're going to roll this thing out. We want to see how we shall roll the thing out. Let me display the question. Just try to map out this concept. Try to map out this concept. Try to map out this concept. Tell us what we have. Tell us what we have. Great. I can see good analysis there. But they have given us maximum capacity. It's not 3 points, 3075 hours. 3075 hours. 3075 hours. This is 3075 hours. 3075 hours. So pata potea. Cheza kama wewe, cheza kama wewe, cheza kama wewe. Cheza kama wewe. Cheza kama wewe, cheza kama wewe, cheza kama wewe. Cheza kama wewe. So ukicheza kama wewe, unasema mwalimu, 3075 is what we have here as the hours what here available, 3075. So for sure there is a deficit there, a deficit of 675, a deficit of 675. So this deficit, fortunately, the deficit fortunately can be covered by the last product. The deficit fortunately can be covered. Remember, I'm recovering this deficit upwards. I'm recovering the deficit from my products upwards. So I'll come and say here, minus 675. I'll come and say minus 675. Please give me an answer. Minus 675. It's 615, sorry. 615, I'm being told it's 615. Minus 615. Please give me an answer, minus 615. So then that will give me what figure at the end of the day? We subtract 2880 minus 6, because you know we don't have these hours, so we need to subtract them from our worst ranked product, So 2265. Thank you very much. So meaning, ladies and gentlemen, that for A we can't be able to produce 144,000. You must cut this because you have cut hours. So you're cutting this and calculating a new A. So then this will be A times 0.02 equals 2265. So meaning that A will be 2265 divided by 0.02, which will end up giving us what figure? 2265. That gives me 113, 200, 113, 113, 113, 200, 113,000, 113,000, 113,250, 113,250. Thank you very much. So A, so therefore the production, optimal production. So the number of units yet to be produced, number of units to be produced, number of units to be produced, number of units to be produced. So we have boy, we have A. So boy, what do we have there for boy? For boy, what we have here for boy, you've told me, boy, you're not altering boy. Boy is 54,000, that is boy. And then A, we have A, you've told me A to produce 113, 250. So please, I'm interested in total contribution. I am interested in total contribution, or you can come and do this as a separate working profit statement. So profit statement, we are looking at profit equals CMX minus fixed cost. So we have boy, it will be 54,000 times the contribution per unit. Contribution per unit for boy is 26. And then we have for A, you've told me to produce 113, 250 times 30. So could you kindly give me these figures? Kindly give me these figures. Why should you not less 615 from B? Remember, when you are given an opportunity to cut down on some product, to cut down on some quantity of some product, you can't start cutting down on the most preferable, the best ranked. This is best ranked. We normally start from the worst ranked, the worst ranked. We normally start from the worst ranked, remember, the worst ranked. So normally start from down upwards, from down upwards. Okay, okay. So could you kindly give me these figures very fast then? Please give me these figures very fast. Tell me what do we have there. Tell me what do we have here. Tell me what do we have here. So B, what do we have here for B? What do we have here for A? Please give me the total contribution. Please give me the total contribution. Please give me the total. B, I'm being given a figure of 144,000. B, we have 144,000. How about A? How about A? A is 33,97,500. 33,97,500. Thank you very much. So therefore, the total contribution will be how much? Then come under less fixed cost. Come under less fixed cost. So total contribution, I've not seen anybody giving me the total contribution. I'm here to get anybody giving me the total contribution. I'm yet to get anybody giving me the total contribution. I'm yet to get anybody giving me the total contribution. What do we have? Somebody there? What do we have? Somebody there? 48,01500. 48,01500. So how about the fixed cost? Fixed cost has been given to us by the examiner. Fixed cost has been given to us by the examiner. So the fixed cost which has been given to us by the examiner, 1470. 1470. 1470. The total fixed cost is 1470. The total fixed cost is 1470. So first of all, is this figure correct? Is this figure correct? 48,01500. Is the figure correct? Yes or no? Is the figure correct? Yes or no? Is the figure correct? Yes or no? Yes. So then come and subtract fixed cost, fixed cost, fixed cost, fixed cost, fixed cost. So fixed cost, which is 1470,000. Fixed cost is 1470,000. Fixed cost is 1470,000. So subtract this, and you'll be able to give us the profit. You'll be able to give us the profit. Profit over how much? Please subtract. Profit over how much? Profit over how much? Profit over how much? $33, $31, $500. $33, $31, $500. Then you are at home. You've already finished that question. You've already finished that question. You've already finished that question. You've already finished the question. You have already finished the question. It's important for ACCA that you get to check your answers. ACCA, it's very important that you get to check your answers. Yes, it's here. The net profit is 33,31,500. 33,31,500. You guys should clap for yourselves. I'm so sure if it was an exam, you would have gotten all those marks. There is nobody who would have lost anything there. There's nobody who would have lost anything there. All of us would have gotten everything. We are bright. We are bright. We are bright. We are bright. Yes. So very fast, could we try question number 20? Very fast, let's try question number 20. Question number 20. Question number 20. So question number 20B, division Y of Chardonnay currently has capital employed of 100,000 and earns an annual profit after depreciation of 18,000. The divisional manager is considering an investment of 10,000 in a net asset which has a 10-year life with no residual value and will earn a constant annual profit after depreciation of 1,600. The cost of capital is 15%. Calculate the following and comment on the results. They want you to give them the return on investment before and after the new investment. And then number 2, the divisional residual income before and after the new investment. They're giving us free marks there, free marks there. Could you kindly try that question? Anybody with an idea, or do you want Mwalimu to do the question very fast? I can see comments here. I can see comments there. No, these were the answers. Earlier on given answers. Nobody has given me anything there at all, really. Nobody has given me anything there at all, really. It's a very easy question, very easy question. Nothing really there. Fortunately, they gave me profits after what year depreciation, right? Profits after everything has been taken care of, right? Right? So no adjustments for depreciation at all. The only thing that I need to do is to come and arrange my work very well. So I need to come and arrange my work very well here. I need to come and arrange my work very well. So I need to come here and arrange my work very well. So then what do we have here, ladies and gentlemen? What we have here basically is the formula. So we have here ROI. Remember, ROI is the same as what here? ROCE. That is return on capital employed. Where to get this ROCE, we will take profits here, profits divided by capital employed. Capital employed. Times who? Times 100. So then I have here before investment and after investment. So I'm looking at the two. So I have profit here. I have capital employed here. So before making any investment, have they given us the profit? Before making any investment, do we have the profit before making any investment? Before making any investment, what profit are they giving us? They gave us division Y of Chardonnay currently has capital employed of 100,000 currently. So that's before. Capital employed is 100,000, right? And the profit of what here? 18,000. Profit of 18,000. 18,000. And then we have the investment itself here. I can even have a column for investment itself. So the investment itself, ladies and gentlemen, What have they told us about investment? What they've told us about this investment is this. The divisional manager is considering an investment of 10,000 in an asset which will have a 10-year life with no residual value and will earn a constant annual profit of 1,600. So the investment, the profit here will be 1,600, and the investment itself, the capital to be employed there is 10,000. Is 10,000. Great. So it means that profit after investment, the profit after investment added the two, this will be 19,600, and then the capital employed will be 110,000. So that is it. So now come and give us the ROI. Come and give us the ROI. So the ROI, what do we have? It will be this divided by 100,000. 18,000 divided by 100,000 times 100 if you wish to make it percentage. So before will be what percentage, somebody? Before will be what percentage? Before will be what percentage? Before will be what percentage? Somebody is telling me 18%. Somebody had gotten these figures. 18%. How about ROI for the investment itself? ROI for investment itself. ROI for the investment itself. ROI for the investment itself. This divided by this times 100, 16%. So meaning that this is a useless project. I will reject this project because this project is pulling down my ROI. Once I have the current ROI, the project, of course, it's profitable. I can see a profit of 16 for every 100, but because it has got a lower ROI than the current one, it's a down puller. It's a down puller. It's a down puller. This thing will pull me down. And that, of course, will be evidenced by what here? By looking at the overall ROI, which will be 19,600 divided by 110,000, which will give me what figure somewhere? 19,600 divided by 110, which is 17.42. So we are worse off. Therefore, the new investment is bad. The new investment is bad. The new investment, according to ROI, the new investment is bad. It's bad. It has pulled down our ROI. So using the same concept, ladies and gentlemen, they want us to calculate what here? The residual income. The residual income before and what here somebody after the new investment. So residual income, is there anybody who is able to remember the residual income formula? Is there anybody who is able to remember the residual income formula? So residual income formula, what do we have? I love so much the residual income. I love so much the residual income. Residual income, ladies and gentlemen, residual income, we normally take profit minus who? Minus Coca-Cola. Profit minus Coca-Cola. Profit minus Coca-Cola. Profit minus Coca-Cola. So then we have here profit minus Coca-Cola. So we have here before. So before, are you able to see the profit before? Before, of course, is 1,800. After, the profit is what here for after? After profit is 19,600 minus. Have they given us the cost of capital really? Have they given us the cost of capital? It's here 15%. So minus the cost of capital, it's here 15%. So we have here 15%, both of them 15%, 15%. So times, in this case here, the capital employed in each, remember it's 15% of the capital employed. This is cost of capital employed, cost of capital employed. So 15% of the capital employed for before is 100,000. And for after, it is what here, somebody capital employed, 110,000. So could you kindly give us these figures there? Could you kindly give us these figures there very fast? Kindly give us these figures there very fast. Kindly give us the figures there very fast. So we have 3,000, and then we have got what there? 3,100. So according to residual income, the project is good. 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 According to residual income, you can see the total residual income increasing. Therefore, the project is good. The project is good. So now listen to me very well, ladies and gentlemen. You can actually, this is what was being asked in part A, to compare and contrast the use of residual income and return on investment in divisional performance measurement, stating the advantage and disadvantage of each. So to move fast, I'll simply go to the answer here. Question number 20. Question number 20. So this question number 20, question number 20, question number 20, 19,600. I can see they got 17.8. How comes you guys gave me 17.4? I can see they have 17.8 as the after investment ROI. Are we the ones who are wrong, or they're the ones who are wrong? ACCA can't be wrong. ACCA can't be wrong. ACCA can't be wrong. 19,600 divided by 110,000. ACCA can't be wrong. Oh, it is 17.82. Yes, thank you very much. Sorry for that. Please correct if you had written my figure there. So the ROI will fall in the short term. So there's a problem there. Then we have 3,000 versus 3,100. Residual income will increase if the new investment is undertaken. The use of residual income has highlighted the fact that the new project returns more than the cost of capital, which is okay. So part A, the difference between this residual income and the ROI. So residual income for a division is calculated by deducting from the divisional profit and imputed is notional, cost of capital, imputed interest charge based on the investment in the decision. The return on investment is the divisional profit expressed as a percentage of the investment in the division. Both methods use the same basic figure for profit and investment, but the residual income produces an absolute. Absolute means in terms of money. Absolute means in terms of money measure, whereas return on investment is expressed as what year a percentage. Both methods suffer from disadvantages in measuring the profit and the investment in a division which include the following. Of course, both of them are using profits. So profits is a short-term measure, myopism, where you don't see very far. So you're told here, assets must be valued consistently at historical cost or at replacement cost. Neither valuation basis is ideal. So basically here we are saying that for us, we have to be consistent in terms of how we record our book values. So basically we shall be using what we call net book value after depreciation, net book value. Number two, divisions must use different bases to value inventory and to calculate what year depreciation. Disadvantages. 3, any charges made for the use of head office services or allocation of head office assets to divisions are likely to be what year to be a bit. Ladies and gentlemen, the most important thing you're supposed to understand about the disadvantages of these methods here, we are making use of net book value. So if you happen to, it doesn't give, the methods here do not give an allowance for revaluations in between. If you give an allowance for revaluations in between, people will try to play around with these figures. So we must, in this case here, maintain all our books at the historical cost, which is what here, the cost we bought these assets minus the depreciations, net book value basically, right? Easy now utakumbuka. In addition, return on investment suffers from the following disadvantages. This absolute model. Rigid adherence, the need to maintain ROI in the short term, can discourage managers from investing in new assets. Since average divisional ROI tends to fall in the early stages of a new investment, residual income can overcome this problem by highlighting projects which return more than the cost of what year capital. It can be difficult to compare the percentage ROI results of divisions if their activities are very different. Residual income can overcome this problem through the use of different interest rates for different what year divisions. Ladies and gentlemen, these solutions are too technical. What I wanted you to understand is this. What I want you to understand is this. Assuming, listen here, assuming you have this project. So we have here, year 1, year 2. So we have profit here. Year 1 is 10,000, assuming you also make year 2 10,000. We have in this case here our net assets value. Net assets value, these are the same as capital employed. So assuming capital employed in year 1 is 20,000. Year 2 we still have the same motor vehicle, but now it has depreciated. It has depreciated by a whole 2,000. So giving me 18,000 here. So if somebody tells you to calculate ROI, ROI, of course, is profit over net assets, profit over capital employed. Could you kindly give me ROI for year number 1? It's a very huge. ROI for number 1. ROI for number 1, 10,000 divided by 20,000 gives us what figure? Somebody there times 100, 50%. 50%. How about year number 2? It will be 10,000 divided by 18,000. Could you kindly give me this figure? Could you kindly give me this figure? 10,000 divided by 18,000. Could you kindly give me this figure? 10,000 divided by 18,000. Could you kindly give me this figure? So it is 55.5%. Thank you very much. So what is your take on ROI? As time progresses by, somebody will say that we are doing very well, that the return on investment is decreasing. But you see, if you look at this thing now with a deeper eye, the profits were the same. This ROI has only increased because of what here? A reduced capital employed, because of the depreciation advantage. So then is this measure the very best really a measure, ladies and gentlemen, that there is showing things are improving simply because we have our assets value going down? That as the assets value reduce, we are having, in this case here, ROI increasing. That is very wrong because it will encourage what we call myopism. Under myopism, managers will not see very far to increase their asset base. Like just the other day, we read that the asset base of KCB has reached a trillion mark, 1 trillion, just like Equity Bank. So of course, as the assets of such a company increases, then automatically the ROI will be going will be going down. So if you're using ROI to evaluate the performance of these entities, then ladies and gentlemen, you will discourage the people who are decision makers here from investing in in assets, because for them, they know that actually, if they sell even some assets, if they hide even some assets, then automatically the asset value will go down, and then ROI will do ROI will go up. And that is why under the two models, actually, we are told to discourage this concept of revaluation. Because if you encourage revaluations, if you don't measure these assets using net book value, if you encourage revaluations, then these managers will come at the end of the year calling in valuers, so that now these values here will straight away go to bed with them, and then of course be undervaluing assets, right? So at the end of the day, residual income is a better model. Why? Because residual income can never reject a project that is profitable. Here, at the end of the day, ROI, you'll get ROI. As long as ROI goes down, you'll get somebody telling you, no. For residual income, so long as a project's return is more than the cost of capital, it will never, in this case here, reject such a project. So residual income is a superior model. Residual income is a superior model. I hope you've been able to pick something small there about these particular models, residual income, and we have ROI. The most important is to have just an idea. The moment you have an idea, you'll be able to know how to defend yourselves. You'll be able to know how to defend yourselves in an exam situation. Great. Okay. Of course, variances cannot be missed, but I don't have time to really work out on something huge. Right now, we want something that we can finish in a minute. So what we can finish in a minute is activity-based costing. Let me see. Yes, we can even just discuss this 18. Even if it's a theory question, it's important to discuss them 18. At a recent board meeting of spring, there was a heated discussion on the need to improve financial performance. The production director argued that financial performance could be improved if the company replaced its existing absorption costing approach with an activity-based costing system. I love this activity-based costing. Activity-based costing, you guys should even look at a computational question of activity-based costing. I love activity-based costing. They argued that this would lead to better cost control and increased profit margins. The managing director agreed that better cost control could lead to increased profitability, but informed the marketing that they believed that the performance needed to be monitored in both financial and non-financial terms. They pointed out that sales could be lost due to poor product quality or a lack of after-sales service just as easily as by asking for too high price for Spring's products. They suggested that while the board should consider introducing activity-based costing, it should also consider ways in which the company could monitor and assess the performance on a wide basis. So they want us to discuss the advantages and disadvantages of adopting an ABC, activity-based approach to cost accumulation. And then B, explain the need for the measurement of organizational and managerial performance, giving examples of the range of financial and non-financial performance measures that could be used. That could be used, like customer satisfaction is a non-financial performance measure. So I want to give you a minute. You try figuring out what is being asked here. Try mapping out the question. Try mapping out the question. Okay, ladies and gentlemen, this is quite a very simple question. Part A, they want us to discuss the advantages and disadvantages of adopting ABC, activity-based costing system. Now, ladies and gentlemen, what I'll remember, I may not remember everything, but what I can never forget about ABC in terms of advantages, ABC, remember under ABC, you must sit with your management. You must sit with the people who are in charge of making key decisions in this company and come up with the various activities that we have as an organization. The various activities that we have as an organization. Right? So we come up with the various activities and what we call the drivers. What we call the drivers, what is really driving these activity costs. So the very first thing that I need to know, ladies and gentlemen, if I'm going to use ABC, then as a CEO, I'll be able to understand, have deeper insights about what drives my costs in this organization. Like if it's a college, I know the biggest cost driver. The biggest cost driver in my college, I know it is the lecturing cost. So once I've been able to understand my biggest cost drivers, I can never allow, for example, many teachers or rather teachers to just attend classes anyhowly as they do signups. I know at the end of the day that will have an impact in my bottom line. So ABC, the very first thing you're supposed to understand, ladies and gentlemen, is that unlike the traditional methods, like what we call the absorption costing method, under ABC, we are going to have all the activities, we have the cost drivers. So at the end of the day, we understand deeply what drives this cost, and therefore we shall be able to control our costs much better. So it leads in this case here to cost control, optimal cost control. Optimal cost control, simply because we understand what we understand our overheads and what drives them very well. That is the biggest advantage, So in terms of getting deeper insights, if it's ABC, ladies and gentlemen, that you're using, it will also, of course, enable management understand their firm much better. Because you see, remember, the ABC, you must start from departments. Which activities shall we be undertaking next year? So when they are listing these activities, of course, in this case, we shall even further understand our organization much better. So many managers out here are managing businesses that they don't even know what is happening inside there. I know of so many of my friends here who are running hotels, which they don't understand what happens at the back end of the hotel. They only seem to think that when a guest comes like that, food is, no. There's quite a lot that goes on behind the success of these businesses, which if we are to run them very well as managers, then we need to understand really. So better understanding of the company is one other advantage that we shall have under ABC. Does it have problems? Yes, many problems. First of all, how you come up with these activities is quite an arbitrary thing. It's a subjective thing. There is no science behind defining of these activities, no science. If you give individual A, take them to CPA department at RCM, tell this individual A to come up with the activities. He'll tell you number one, for example, teaching, number two, whatever. Bring another person, take him to the same department. This guy will end up giving you what here? Different activities. So you're saying, ladies and gentlemen, that coming up with the activities is very what here? Subjective. Is very subjective. There is no scientific way. And then at the end of the day, ladies and gentlemen, remember ABC, just like the other methods, there is no way you will be able to avoid absorbing overheads. There is no way you'll avoid apportionment. You'll still be apportioning overheads. And of course, you know that apportionment of overheads is a complex exercise. is a complex exercise. So it has a lot of what here? Complexities. So you need some technical knowledge for you to be able to run an ABC system. Anytime they tell you to discuss about disadvantages of any accounting, costing system, always remember lack of what your technical skills as one of them of running that system. That system is very expensive. The system is time consuming, etc., etc. We could just go through the answer given by SCCA. We shall be able to really move with speed. Here. So we are told, ladies and gentlemen, here, that's 18. So 18, advantages of ABC. I'll just read very fast. The complexity of manufacturing has increased with wider product ranges, shorter product life cycles, and more complex production processes. ABC recognizes this complexity with its multiple cost drivers. In a more competitive environment, companies must be able to assess product profitability realistically. ABC facilitates a good understanding of what drives overhead cost. In modern manufacturing systems, overhead functions include a lot of non-factory flow activities, such as product design, quality control, production planning, and customer services. ABC is concerned with all overhead costs and so goes beyond the traditional factory flow boundary. Ladies and gentlemen, they're not even giving us a very good answer here. The only thing that I'm able to pick from the answer is this. ABC facilitates a good understanding of what drives overhead cost. The answers that I would have picked, or rather which I expected ACCA to give me, number one, is that better understanding of what drives costs. That is very good for me to have my fingers on those activities that drive my cost, for me to be able in this case here to seal kibeti yangu vizuri ndio pesa isiende nje. The other thing is all about understanding of what here the company much better during the concept of listing of activities. The other one which they have vaguely been able to bring out is the concept of what here better profitability analysis. When you're using activity-based costing, your profitability statements normally come out so well. How about disadvantages? It has been suggested that critics here that ABC has some serious flaws. Some measure of cost apportionment may still be required at the cost pooling stage for items like rent, rates, and building depreciation. Unless costs are caused by an activity that is measurable in quantitative terms and which can be related to product output, cost drivers will not be usable. What drives the cost of an annual external audit, for example? This is a very good disadvantage. This disadvantage, ladies and gentlemen, here, which they're talking about here, is a concept that for us to be able to use activity-based costing, then there must be a relationship. There must be a relationship between the cost driver and the expense itself. The two must be related. So, for example, you're saying wages is related to number of hours. So number of hours are able to drive our wages, right? But there are some expenses in this case here that are not driven with anything, which don't have relationships. For example, ladies and gentlemen, like rent, even if I was to have, say, 50 students here, rent for this studio still will be the same. So rent in this case here does not have a cost driver. So we are saying that ABC, which is a very big disadvantage, is only useful in situations where we have clearly stated relationships between cost drivers and the cost expenses themselves. So if there are no relationships, then automatically we shall not be able to do what here? We shall not be able to really do the activity-based costing. Ladies and gentlemen, I want us to cut. ABC sometimes introduces because of, just to cut this short, difficulty in determining appropriate cost drivers. Yeah, it's very difficult, very subjective. lack of correct type of data. And then we have the concept of complexity being brought up there. That works for me. Go back to Roman 2. Roman 2 of this question, Roman 2 of this question number 18. Roman 2 of this question number 18. Roman 2 of this question number 18. So Roman 2 of this question number 18, they want us to explain the need for measurement of organizational and managerial performance, giving examples of the range of financial and non-financial performance measures. So explain the need for the measurement of organizational and managerial performance. Why, ladies and gentlemen, do we need to measure the performance of these managers out there? Like the other day, you saw CEO of KCB, I mean, getting 128 million Kenya shilling in form of bonuses, right? Why is it important for us to measure the performance of these managers and the organizations as a whole? Could you kindly try giving me an answer to that? Why is it important for us to measure the performance of managers, the performance of organizations? I'm waiting. I can see their charts here. I'm waiting. I can see their charts here. Okay. To know growth of a company like this, helps in allocation of resources, yes. To check whether targets are met, yes. Great, great, great. Dividends to be paid, yes. Thank you very much. And ladies and gentlemen, listen and listen to me very well. All your answers are correct. The only thing that you guys, perhaps I've not seen you guys raising with me, is that when you are measuring, why you should measure performance of a company, basically measurement of performance of a company is the biggest control, is part of the big internal control systems. Remember, as we get out there into our jobs, we know at the end of the day that normally human beings are naturally, all of us are geared towards theft. All of us, naturally, we are greedy. And there is this survey that was done just the other day in Kenya, where they said about 75% to 80% of the employees in the morning, or rather every morning, go to their workplaces with an intention of stealing. They want to steal. They want to steal. Of course, I know those thieves are not here. Here I have good people. The concept is this: if you don't measure the performance of an organization, you'll be giving leeway to people to do to steal from this company. So it's important that every day, look at all these companies that are very successful. They invest in performance appraisal systems. Performance appraisal systems, simply because performance appraisal is part of is part of the major internal control, actually the biggest internal control system. We measure performance, ladies and gentlemen, of course, here with what objective? With an objective of improving in terms of how we operate, right? We measure our performance, ladies and gentlemen, simply because we would want to reduce on our idle capacities. We would want to reduce on our slack times. right? And of course, many other points that you guys have been able to do what year to give me, not forgetting that it's important that we get to measure performance, even for purposes of what year? Our investors who want dividends, even for purpose of bringing in new investors. Because if you want to bring in new investors, ladies and gentlemen, then automatically at the end of the day, you need something to show them. You need something to show them. If you want credit from a bank, you need something to show them. So this that is to be shown to them will come out of what year? This particular what year performance appraisal, even for purposes of motivating, workers, you need to know how are they performing? That is very important. Now, ladies and gentlemen, here we are. Like that budgets and people is very important. So they're telling us here, part B, that performance measurement is part of the system of financial controls of an enterprise, and as well as being important to investors. Managerial performance and organizational performance are linked, since the decisions that managers make will influence how well or otherwise the organization performs. This performance needs to be measured as part of the control process. The key elements of such a process are which ones here? You start by budgeting, right? So you must put plans here. So we have plans and targets are set for the future. Step number 2, plans are put into operation. Step number 3, we have the actual results are recorded and analyzed. And then we have information about actual results is fed back, right? The feedback is used by management to compare actual results with the plan. So basically you are computing what you have variances. You're computing variances, etc. That was not the major thing. Now from there is something, ladies and gentlemen, that these guys had asked us to give them the financial performance measures and the non-financial performance measures. So the financial performance measures are here. You can see like earnings per share, dividend per share, gearing levels, profits, all those, ROCE, right? All those are very important what year performance measures, just examples. And then for the non-financial performance measures, you're looking at issues to do with quality, issues to do with customers, number of customer complaints, right? We have delivery time, flexibility, machine downtime, etc. That is it, ladies and gentlemen. And we have now come to the end of this particular session. It has been a pleasure hosting you in the morning. And I hope you have at least understood today's session. Thank you. Bye-bye. Good day.